Welcome to the deep dive. We're here to cut through the chatter and get straight to what really matters. Today, we're zooming in on the Indian Hotels Company Limited, IHCL. Really quite a story here of resilience and smart strategic growth. We're looking at their Q1 FY26 results, and get this, it's their 13th consecutive quarter of record performance.
Yeah, that's quite a run, 13 quarters. Especially given, well, everything going on globally. And you've given us a good set of sources. The analyst presentation, the press release, and the earnings call transcript itself. Loads of detail there.
Right.
So our mission really is to pull out the key nuggets. How did IHCL keep this momentum going, accelerate it even, especially with those headwinds we know they faced?
Yeah, exactly. Think of this as your shortcut, to getting up to speed. We'll break down the numbers, look at maybe some surprising factors behind this success and what it means for hospitality generally. So let's dive in. Thriving amidst challenges, that seems to be the theme here.
It really is. I mean, look at the headline numbers first. Consolidated financials for Q1 FY26. Revenue up 32% year on year. That's huge.
32%. Wow.
To 2,102 crores. And EBITDA, the core profitability measure, grew 29% to 637 crores.
Okay.
Even the bottom line, profit after tax, climbed 19% to 296 crores. So just really solid numbers across the board.
But it wasn't all smooth sailing, right? I saw in their presentation they actually called out some lowlights.
That's right. They were upfront about it. Booking cancellations linked to Operation Sindoor, that situation near the India-Pakistan border, that had an impact.
Right.
And then the geopolitical stuff. The Israel-Iran conflict, airspace closures, flight disruptions, all that played a role.
And they actually quantified that impact, didn't they?
They did. They estimated those events alone cost them about 2 to 2.5% of potential hotel revenue growth, which is, not insignificant.
Definitely not. So against that backdrop, how did the hotel segment still manage strong margins?
That's the impressive part. The hotel segment's EBITDA margin was 31.4%. That's actually up slightly, 0.3 percentage points.
Okay, so how? Operating efficiencies.
Exactly. They mentioned things like centralized buying, tight cost control on consumables, leveraging their scale, essentially.
Makes sense.
And optimizing staffing using tech, especially in areas that aren't guest-facing. So maintaining service, but, being leaner behind the scenes.
That's smart. I also noticed something about payroll costs. An 11 crore increase because they moved their salary hikes forward.
Yeah, they preponed their annual increment cycle from July 1st to April 1st. So that hit Q1 specifically.
What does that tell us? Just looking after their people.
I think so. A proactive move. They said the impact should even out over the rest of the year. It kind of speaks to their overall approach, maybe even links back to their brand strength.
Oh.
Well, if you connect it to the accolades, Taj being rated world's strongest hotel brand again, India's strongest brand overall by Brand Finance, that kind of reputation is built on many things, including how you treat your people and your customers.
So that strongest brand title, it's not just a label. It actually helps them perform better, especially when things get tough.
Absolutely. It gives them pricing power. People trust the brand, especially in uncertain times. They're often willing to pay a bit more for that reliability.
Right.
And it probably helps with direct bookings, reduces reliance on third-party sellers, insulates them a bit from market swings. It's a real asset.
Okay, so they're clearly resilient, but they didn't just stand still, did they? They were actively growing. Let's talk about that strategic growth.
Yeah, the expansion pace is pretty remarkable. Signed 12 new hotels, opened 6 just in Q1.
Just Q1. Wow.
Brings the total portfolio to 392 hotels. They're getting really close to that 400-plus goal. And remember, their Accelerate 2030 plan aims for 700 hotels.
700. That's huge ambition. How are they managing that kind of growth? Is it all capital intensive?
Not necessarily. That's where the asset-light strategy comes in. Their management fee income was up 17% to 133 crores.
Okay, explain that asset light bit more. It means they manage hotels they don't own.
Exactly. They partner with property owners, bring in their brand, their management expertise, and earn fees. It lets them expand much faster without needing billions in capital for construction or acquisition.
Like franchising almost.
Similar principle, yeah. It boosts their margins because management fees are generally high margin compared to owning and operating everything yourself.
But does that create risks? Like maintaining the Taj standard everywhere if you don't own the building?
It's a valid point, but they manage it through really strict brand standards, constant audits, training, and careful partner selection. The focus is making sure the guest experience is consistent regardless of the ownership model.
Got it. And it wasn't just the core Taj brand growing, right? Those new businesses saw big growth too.
Huge growth, up 27%. That includes Ginger, Cumin, the Amman Stays and Trails Homestays, Tree of Life. It's quite a diverse mix now.
What's driving that? Anything specific?
Ginger stood out. 25% revenue growth there, helped by flagships like the one at Mumbai Airport.
Right.
And they talked about the humanization of Ginger. It's an interesting concept, moving beyond just being lean luxe or budget focus.
Humanization. What does that mean in practice?
Adding things like distinct human-branded restaurants within the Ginger hotels, not just a generic coffee shop, but something with its own identity. It boosts the food and beverage side and makes the stay feel, well, less basic, more curated.
Cover. And wasn't there a specific deal involving Ginger near Kolkata Airport with the Tata Group?
Yes, that's quite interesting. The Tata Group acquired an under-construction hotel there, and IHCL will operate it as a Ginger under a revenue-based lease.
So IHCL doesn't own it, but operates it. Fits the asset-light model again.
Exactly. And the suggestion was this could be part of a broader strategic asset platform within Tata, a dedicated way for the group to acquire properties for IHCL to manage, making that asset-light expansion even more efficient, especially focusing on key locations like airports for Ginger.
Okay, so lots of innovation in the new segments, but the traditional business is still doing well.
Oh, yeah. Very well. RevPR revenue per available room, that key metric was up 11% for their consolidated domestic hotels. And that's like for like.
So comparing apples to apples, excluding the new hotels.
Correct. It shows the underlying strength. And their owned international hotels saw 13% RevPR growth, also strong.
What's supporting that domestic growth?
Yeah.
Is demand just high across the board?
Demand is strong, yes, but there's also a supply factor. About 3/4 of their domestic revenue comes from key business cities.
Okay.
And in those cities, the pipeline for new hotel supply is pretty limited. Less than 5% growth expected annually through 2030.
So limited new competition means they have better pricing power.
Precisely. It helps push that RevPR up.
Were there any specific cities that really stood out?
There were. Kolkata saw 50% RevPAR growth for IHCL consolidated. And Hyderabad also hit 50% growth, though that was significantly boosted by the performance of the Falaknuma Palace, which is obviously a unique high-end property.
50% is huge growth.
It really is. And another interesting point from the earnings call, a bit surprising perhaps, was the strength in spiritual destinations.
Spiritual tourism, like what?
Places like Banaras, Varanasi, they mentioned they're actually doubling the size of the Taj Ganges there. Also, Tirupati, Puri, properties in these locations are apparently performing very resiliently.
So people are traveling more for religious or spiritual reasons.
Seems like it. They noted a distinct increase in spiritual tourism across India, and it's proving to be a steady demand driver for them.
Fascinating.
Yeah.
Okay, let's shift to the financials underpinning all this. Their balance sheet looks healthy.
Very healthy. Gross cash balance was over 3,000 crores, 3,073 crores to be exact, as of June 30th. That gives them a lot of flexibility.
And they plan to spend a good chunk of that, right? CapEx plans.
Yep, planned capital expenditure of over 1,200 crores for FY26. They're definitely investing back into the business.
What's that money going towards? New builds, renovations?
Mix, really. Some is for assets currently under construction, like the Taj Bandstand in Mumbai. They just got the environmental approval for that in July, apparently.
Okay.
Then there are major renovations. They mentioned Taj Palace Delhi and Fort Aguada Goa, specifically noting these are full refurbishments, so rooms are actually taken offline temporarily.
Right, good projects.
Plus ongoing expansions at existing properties and, importantly, investments in digital initiatives, enhancing their tech stack.
And internationally. Are they still expanding their footprint outside India?
They are. A key one coming up is the Taj Hotel Hestethof in Frankfurt. That's slated for Q4 of this fiscal year.
Frankfurt. Interesting.
Yeah, and it'll include one of their Chambers clubs, the exclusive business club, and also a Bombay brasserie restaurant. So exporting those successful concepts too.
That makes sense. Another thing that caught my eye was the Tata Noi loyalty program integration. How significant is that?
It's becoming very significant. They crossed 11 million loyalty members by mid-July.
11 million? That's a lot of members.
It is, but what's interesting is they said that's still less than 10% of the total active Tata Noi super app users. So the potential for growth is massive.
Right. So what's the actual benefit? Just getting points? Or is there more to it?
It's way more than just points. Tata Noi connects data across multiple Tata brands. So IHCL gets this incredibly rich picture of guest preferences, spending habits across retail, airlines, groceries, you name it.
Ah, so they can personalize offers much better.
Exactly. Hyper-personalization. It drives loyalty, increases the lifetime value of a customer, and crucially helps them drive more direct bookings through the app, cutting out the middlemen.
And the numbers back that up.
They do. Revenue from loyalty points earning grew 17% to 545 crores. And revenue generated through the Tata Neu app itself surged 46% to 75 crores. It's clearly a powerful engine for them.
Yeah, that sounds like a real competitive advantage. So putting it all together, their outlook seems pretty positive.
Very positive. They reiterated confidence in achieving double-digit revenue growth for the full year in hotels and 20% top-line growth for TajSats, their airline catering arm.
What's driving that confidence? Just the momentum.
Momentum, yes, but also strong forward bookings, particularly from ICE meetings, incentives, conferences, exhibitions, and they mention high-profile diplomatic visits also boosting demand.
Was there any caution expressed on the call? Any potential speed bumps mentioned?
Honestly, not really. Management sounded very confident. The focus was much more on executing their plans and capitalizing on the demand they're seeing, especially with a diversified portfolio now.
Okay, one last area to touch on their commitment to responsible business, the Pathia framework. Is this just, CSR ticking boxes, or is it more fundamental?
It seems quite fundamental. Integrated into their strategy, they call it ESG plus, ASAS, Environmental, Social, Governance plus.
What are some concrete examples?
Well, on the environmental side, 38% of their energy is now from renewable sources. They have nearly 400 EV charging stations across their properties, bottling plants in dozens of hotels to cut single-use plastic, almost 50% water recycling.
Those sound like they could have cost benefits too, not just environmental.
Absolutely. Reducing energy costs, water costs, waste management costs. It makes business sense. And then the social aspect is huge.
What are they doing there?
Their skilling initiative is probably the headline. They skilled over 31,000 young people since 2020, aiming for 100,000 by 2030. They have 52 skill centers across 20 states.
Wow. Why such a big focus on skilling?
Well, partly it's community impact, but it's also strategic. The hospitality industry often faces labor challenges. By proactively training people, they're building their own future talent pipeline. It addresses a potential business risk head on.
That's really forward thinking. So it's clear this ESG plus thing is woven into how they operate.
It seems to be, yes. Attracting conscious consumers, investors, talent. It reinforces the brand and potentially makes the business more resilient long term.
So wrapping this all up, this deep dive into IHCL's Q1 results really shows a company firing on multiple cylinders, doesn't it?
It really does. You see the resilience against those external shocks, but also this very deliberate, diversified growth strategy. The strong core brands, the asset-light expansion, the new businesses taking off, the loyalty program advantage.
And all underpinned by a solid balance sheet and this commitment to responsible practices.
Exactly. It paints a picture of a company that's not just adapting, but actively shaping its future, even in a complex world.
Which leads to maybe a final thought for you, our listener, to mull over. In a time of constant disruption and, frankly, information overload, look at how IHCL is blending traditional luxury with this leaner, efficient model, how they're embracing new ventures alongside their core, and how they're embedding sustainability and social impact right into the business.
Yeah, the provocative question is, what does this kind of comprehensive, integrated approach tell us about where successful global businesses need to go? Not just in hotels, but across other sectors too. How can others build that kind of resilience and positive impact?
Plenty to think about there. We hope this deep dive is giving you some valuable insights into IHCL's performance and strategy.
Definitely encourage you to keep an eye on how companies like IHCL continue to evolve and set benchmarks. Thanks for tuning in.